to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Shreyash Devalkar, Head of Equity at Axis Mutual Fund. Shreyash, good to have you back with us.
It's my pleasure to join this.
Now, to begin with, Shreyash, equity markets are hitting new highs. What do you think is driving this rally, and also can it continue in the long term?
See, the rally, which is currently, which is there since last 3-4 years actually now. Mostly, it is led by two things. One is definitely micro, that is the earning growth, which is across the board. Probably in last decade, the growth was concentrated in few sectors and few companies, while the rally this time has been broad-based, right from the investment part of economy, some sections of consumption part and export. So it's broad-based. Uh, the reasons for continuing is apart from obviously everyone understand the valuations are high, and then what is still driving it, because earning growth is has been there, but for the earning growth, whether the valuations are really high, whatever we are delivering. On that front, when it comes to fundamental and especially the top-down level fundamentals, in India, our the key parameters which all the investors watch is fiscal deficit, current account deficit, inflation, interest rate cycle, which is expected to head down southwards, and growth. So these are the few parameters on which one definitely India looks superior than the rest of the world, and that's where on that macro front, I think there is a comfort. Even from the current levels, when the valuations are really high, the comfort generally market is driving is from this angle. The other part, which is from the export side, or the other part, which is especially on the foreign front, which obviously affects us through exports and both movement of capital and goods. In that scenario, general expectation is yes, there will be cut in the interest rate globally as well, but that cut without much damage on the demand worldwide is what is the contentious issue. And as an investor, one should be mindful of that whether the slowdown and the growth coming down, and that's where the interest rates falling globally, whether it will lead to recession or whether it will lead to slowdown in the growth as far as exports are concerned. So that remains a concern on the top down basis.
Dinesh, given the valuations, high valuations in the market, uh, how are you looking at the opportunities currently, and which are the sectors where you are finding value in this current market?
See, value-wise, if you use multiple metric for value, so I don't see much value in the market. So there are only segments which are overvalued, and some other which are less overvalued. I think these are the two categories one can say. One more metric one can use is valuation compared to the pre-COVID level. And in that context, whether on a relative basis, some sectors have got re-rated lesser than others or not. So if we use these 3-4 metric of valuation, because as I said, absolutely India has been never cheap, and probably in this market definitely you will not find absolute value anywhere. On a relative basis, definitely one should look at some sectors. So if you notice the broader sector, which are mostly represented in the large cap, is one is the private sector financials, where there is no re-rating. Actually, to some extent, there is a de-rating when it comes to private sector banks, especially. So that is one pack. The other pack where there is a value on a relative basis is FMCG, because FMCG sector has always been expensive. It is not that now it is not it is expensive. But only point being that its valuation today are they are also at premium to their earlier or historical valuations. But however, now if we compare to some other sectors like capital goods and chemical, some export-oriented sectors where there has been theme. There, the valuations are 2x, 3x of their pre-COVID. So in that context, this segment has got re-rated less. The third segment, which also got re-rated, but to the lesser extent, is the pharmaceutical. Again, here, as I said, that yes, this also part got re-rated, but everything is in the relative context. And the fourth is IT. So IT also has got related from 1820 to now 2628p. However, again, on a relative basis compared to its pre-COVID valuations, and when compared to the valuations where other sectors, the way they have got re-rated. So these are the 3-4 segments which one can point out based on the metric which I used to call out that yes, there is some valuation comfort. I think based on those metrics, these 3-4 sectors come out.
All right, now, Shreyash, since you started, the market has evolved. Likewise, your investment philosophy, it must have changed over the years. So can you please tell us what was it that you started with, and how has it changed, and how should investors adapt to market conditions as they evolve?
My opinion, investment philosophy is remains same. There is no changes in that per se. Indian market has always been about growth. Actually, and for when it comes to us, investment philosophy has always been quality and growth, and that's where the focus has been on the same, and that's where that philosophy remains. The only thing is with the underlying change in the economy, underlying changes in the sector. The what happens is when it comes to quality, the way you want to measure is by way of leverage, by way of its free cash flow generation, ROC, ROE potential. These are the basic metric you tend to use for the quality, apart from obviously corporate governance. But the way this cycle has been, especially in the B2B businesses, on these metric, many companies and many sectors started ticking on that quality framework, and that's how the market changes, and that's how the opportunities also changes. So when it comes to us, definitely the horizon and canvas on which one should play has definitely expanded because of these underlying changes, wherein now you see high ROE, high free cash flow in multiple sectors compared to only few in last decade.
Shreyash, how do you identify growth stocks and balance between a risk reward in the current market scenario when markets have run up in the last few months?
Probably risk reward is definitely now. If you actually ask me, it's easy today than it was maybe 1 year ago or 1.5 years ago. Reason being now, everything is expensive. So earlier, at least there were pockets where you would have said that this is not, and then 300 stock is not expensive, 500 is not expensive, and 800 stock is not expensive. So the way money has flown and the way market has moved up, on the traditional metric of valuations per se, everything is expensive. When it comes to picking any stock at any point in time, the process remains same for us. Always the question is what valuations you have to pay. And as I said, today the valuations are high everywhere, and that's where on that count, probably sticking to the best companies and best sector would help a lot this time and at this juncture of the market. Because the way you have seen the rotations happening as recent as post-election, if you see the way it has happened is it is away from again capital goods and again back to ITs and FMCGs, and mostly the way stocks have moved, the earning delivery is not commensurate. So I would call it as a more of under ownership driven, as well as more of these rotations which are happening, which are under ownership driven and mostly relative valuation driven. In such a scenario, the 3.6 month period may create certain adverse movement, but one should look at over a year or so from here on, and you will notice that the companies with best growth will definitely give good returns, while the broad-based the rally what we have seen, there may be some consolidation in that, because in last 3 to 4 years, earning upgrades has been there in many sectors, many segments. First by way of top line surprises, then margin surprises. Now, when this phase is getting over, and now you cannot expect margin surprise to keep on happening quarter after quarter for all the companies, and that's where we will see that a certain consolidation happening in this market, with money flowing to those who are delivering on a longer term basis.
Uh, when markets get overheated, Shreyash, do you shift towards more resilient sectors? Because at the AMC level, we observed that a shift from a strong growth orientation to a more relative growth approach, while still maintaining a steadfast focus on quality. So, can investors expect this focus on quality to continue going forward?
Definitely. See, for all of us at Axis, quality is the bedrock for everything. And in this quality, again, it's I would like to rather elaborate on what is the term. The term quality stands for high return on equity, high cash flows, and good corporate governance. Again, there may be some deviations to it, wherein some sectors, which are emerging sectors, where the sectors may be loss making, but at least we try to look at whether the companies are near duopolies or not. Otherwise, and there is any part to profitability, whether they are winner on the ground. So at least such metrics should be there, rather than betting on the businesses which are inherently poor quality and it is not leading to the path to profitability. So these are the basic element of quality, and I think we always have been focusing on that, and we will continue to do so. And investors also need to focus on that, because this, and especially this juncture of market, because earlier there could have been relative valuation stories. Today you may not find relative valuation stories. So the way market probably flocked to FMCG and IT recently, it was more under ownership driven, because valuation of IT is still 20-30% higher than pre-COVID, and probably for the growth which is almost same or marginally lower than the pre-COVID. So, and that's where absolutely you may not find value there.
When we spoke last time around in January this year, you mentioned some portfolio adjustment and increasing the stock to perform to better perform of the few of the funds. However, the blue chip fund and the ELSS fund are still struggling. When can investors see the turnaround in these schemes?
So if I just see as of today, or as of yesterday, actually, the ELSS fund on 6 month basis, definitely it is outperforming handsomely to the underlying benchmark. On YTD basis, it is broadly in line with benchmark, and probably same is the case with large cap blue chip fund. Actually, it is in line with the benchmark on YTD basis as of yesterday, and on the 6 month basis, or 3 month basis. Actually, 6 month basis, it is there. It is not big time underperforming. So net broader point here is multiple funds have seen multiple changes, and you might have observed that most of these funds have started doing well in last 6 months. Some of them have done so well that now it's 1 year also start looking good. So this process is on, and as I said, it is visible in most of the fund, and we will stick to what we have been doing.
So you think so the returns will come back going forward?
See, it's difficult to comment anything on forward looking. But yes, what I can talk about is the processes what we have been following when it comes to quality and growth, and so our blue chip fund, for that matter, has been mostly large cap oriented, and we have maintained it that way, that it is a large cap oriented fund as such. So everywhere we are following the processes the way we have been doing.
Okay. Shreyash, you have been quite a new player in the value segment, if I would say so. So with the global rate cuts on the horizon, how do you see the impacting both the growth and the value stocks going forward?
See, every cycle is different in some sense. So this time around, with interest rate hike cycle, actually there has been stronger growth, and obviously some part it happens that way. It happened in 2006, 7, 8 time period also. And now also it is happening that the growth is strong and inflation is going up and interest rates went up. During this, when it comes to the market and the valuations, actually market in especially in India, the market and the valuations also went up. Now, to expect that when the interest rate cycle reverses, it will further go up is not right to expect, because already it has gone up. And the sensitivity will not be so when it comes to stock prices. In my judgment, the sensitivity will be more to the earning growth rather than the valuation, which is more theoretically based on the interest rates. So the earning growth will drive derate or re-rate the sector more because already the valuations are elevated, rather than fall in the interest rate helping it.
Shreyash, if we look at the midcap fund, it has performed quite well in the last 6 to 8 months. And we have also found some of the new names which have contributing to the performance of the fund. And also some of the long-term bets of the stocks you have been trimming the position. So could you just let us know what is the idea behind the sell decision? How do you sell a stock from the portfolio?
So this portfolio, if you see, we have changed a lot over last 3 years or so. One observation in this post-COVID recovery, economic recovery, it has been, as I said, more broad-based, more B2B driven. And in that context, we started doing changes in 2022-23. And obviously even now 24 also we have started doing changes. So the changes on a historic basis, if you see as of last month and whatever changes we have shown in the last month, and you will notice that yes, we have been reducing from some of the most expensive part of the market, especially in the industrial segment, and that's what and you might have noticed again based on these calendar years changes in sectors, the sectors like pharmaceutical, etc., has gone up in the fund. So yes, these moves or the changes in the fund, they are driven by both valuations as well as the next opportunities, and more so in mid-cap fund and in both in the mid-cap, small-cap category. That is very important in my opinion, because here some of the businesses may break out. As far as business is concerned, when I use the word breakout generally, it is to do with the breaking out of its orbit of earlier businesses. There are certain businesses which has shown that pattern, and if they're showing that pattern, then the valuations, in my judgment, is not much of a concern. So if you notice in our mid-cap fund as well, there is probably one of the top companies, one of the top 10 companies, are more than 2, 3 of them. They could deliver on the returns despite high valuation, because the companies actually break out of their orbit by replicating the formats, by replicating the platform into other segments. So those things are important, and we observe all these parameters when it comes to whether to keep the stock or despite valuation, or sell the stock for the valuation sake. Because if the company is not moving out of orbit, then very high expensive stock, then it becomes at a mercy of earning upgrades, because at 70, 80, earning delivery just in line doesn't help when it comes to stock performance. At that time, either you need earning upgrades or you need companies breaking out of orbit. So both these parameters we keep on watching and act accordingly.
Breaking out of the orbit means, particularly, what does it mean, Shreyash?
So especially in the mid and small cap companies, you might observe that some companies, if they're operating in one product line, they start multiple product lines and they are not exactly in the same line of business. You can call out similar. See, if you're doing the same business, so if you're in FMCG and instead of two soaps, if you're selling third soap, then it is your normal business. But then instead of selling soaps, you tomorrow start selling something else with the same platform and successfully because the brand is strong, because you know execution. Similarly, it can be can multiple sectors you can take just for the sake of example. One may take as auto business, auto ancillary, especially they are representative in the mid and small. So instead of one product line when it comes to auto ancillary, multiple product line, trying to get into the EMS space, electronic manufacturing services space. So this is what I call out as a breakout of or breaking out of the orbit and trying to get into the different scale and different orbit. That scenario generally has helped valuations, and we have seen that companies have created wealth despite high valuation if this scenario pan out. Or there has to be a case of sustained earning upgrades, and those also has been the case around that as well, because of some underlying improvement in the industry structure, and wherein we have seen certain sectors. Just to give example, like telecom sector, it created value because of sustained earnings, the tariff increase, etc. So there has been certain triggers for it. So one need to look at both these parameters. Again, there is one more element which is also very important when it comes to the valuation, is whether a sector or segment or a company is near monopoly. Obviously, there you may not find monopoly as such, but it has to be near monopoly, and because the number two, number three are distant number two, number three, and it takes a lot for them to catch up. So in such cases also we have observed that the valuations remain sustainably high.
Okay. Shreyash, one more thing, just curious to understand, if you are investing in a stock, then how much time will you give a stock to, work out for this rationale to play out? How much time will you give it to a stock?
Actually, more than how much time we give, at the time of investment, one need to be clear that what we are buying for. And generally, we tend to size it accordingly. So if start delivering, then you size up. So you basically invest in any particular company based on certain thesis that yes, this will deliver on its growth, or it will get into new orbit, or it will improve margins. And with that, you generally size less initially. And it is again based on whether you size more or less, it based on what probability you assign to that outcome getting turned out. If that outcome is not happening the way you expected, then maybe the sizing remains low. And so that's how I would look at it, rather than trying to be patient or not patient with the company.
All right, well, that was about the mid-cap fund. Now, in funds like ELSS, Focused, and Growth Opportunities Fund, your exposure to mid and small caps is relatively low. So what is driving that decision, and especially since mid and small caps have been doing well?
So, since you mentioned, say, first is growth opportunities, definitely it is a large and mid-cap space category for us. So it has a sufficient exposure to mid-cap the way regulation has defined it. On the other hand, we have some foreign equities into it and securities into it. And that's where, to that extent, maybe compared to the industry, our exposure to mid and small may be lesser. And that's where that has been one of the reasons why it would have been drag on that portfolio compared to, say, the category returns as such. While on that front, we have actually speaking. We have reduced on the international exposure in that fund, and we have added across the board both large cap and mid cap in that. So I think that portfolio is barring that exposure to the foreign equity is actually in line when it comes to mid and small cap exposure. Coming to long term flexi cap, in all these categories, definitely we have changed a lot. We have added more number of stocks And more than large, mid, small, the way I would look at it is whether portfolio is diversified in consumption, investment, and exports part of economy. And that's what we have tried to achieve in all these funds, that under the fund should be fairly represented in all part of economy rather than totally lopsided on the consumption part of economy as such. So to that extent, all the funds, not only the funds you mentioned, all the funds have got diversified.
Shreyash, but on the other side, if you look at the multi-cap fund, it has done quite well in 2024, and it has a higher exposure to the mid and small cap stocks. So, is it our assessment right? And if not, then what is gone right for the scheme?
See, definitely in last 2 3 years, 4 years, mid and small cap category has done well. So higher allocation to mid and small cap has been the recipe for our performance, no doubt on that. Now, multi-cap fund, by way of its definition, it has to be in mid and small and large, right? And that definitely would have helped it. In addition to that, our fund has also done good in that category. And that goes to the stock selection. Your observation is there are more number of stock. Generally, in my judgment, multi-cap fund would tend to have more number of stocks because it's you are having certain portion allocated to large cap, certain to mid cap, certain to small cap. And with that kind of allocation, generally you tend to have more number of stock than purely large cap fund. So I will give you just example. The way I would look at it is, say large cap category is 100 universe is 100 stock 100 stock, right? And if you have your 40-50% success rate, then you or 45-50% probability of going right, or you have that kind of conviction, then you would have 40-50 stocks in a large cap fund, and that what normally you would observe. If someone tend to add more mid and small, then the number of stocks go up to 60-70. When it comes to now, if you start looking at mid cap category, it's a 150 stocks universe, and then it leads to, if you just go by 50-60% of universe, if you want to buy, then you tend to buy closer to 75 to 90 stocks kind of portfolio. If you then get to the small cap, now small cap is 250 to, it can at 500, 600, 700 based on the size of the fund. And then the number of stocks can be 100 or 120 as well. Now, with the similar logic, when it comes to multi-cap, since you have to allocate certain to large, mid, small, and in each category, if you use this logic, then number of stocks tend to go up with that.
So, Shreyash, I just wanted to understand if the multi-cap fund is doing quite well. If we talk about the stock selection in the mid and small cap thing, then why it is not showing the same performance in the other schemes? Like for example, flexi cap fund, where also you have an option to move across mid and the small cap stocks.
So FlexiCap Fund, since we have its fund manager, Sachin, who had joined us in January. So since he has joined, if you notice, its performance in the category has started improving. So on again, if you look at FlexiCap Fund on a YTD basis in category, so YTD basis FlexiCap Fund is actually outperforming really well to the benchmark as such. And in my judgment, it would be closer to quartile 2 kind of fund.
Shreyash, now coming to the markets, given the current scenario, which are the sectors you believe would outperform the broader markets going forward?
So when it comes to overall market, in my judgment, more than sectors, see, on a 3-month, 4-month basis, the sector rotation which you are observing will may continue. Since there is a lot of flows in the market, and on a quarterly basis, one may find one sector better than other, and as I highlighted that on a relative valuation basis, though some sector may emerge as a better than other, on an absolute valuation basis, in my judgment, mostly everything is expensive. And considering this on a 3 to 4 month basis, one may try to time and judge and take call on some sectors. But on a yearly basis, I think that now we are heading into a market where it will be across sectors, but few stocks which may deliver well. Will be giving you better results than the sector specific or theme specific. So the way market has been that yes, certain themes per se, that power sector theme or a defense sector theme or whatever themes has been there. So I don't think it will be a theme approach the market will take. It will take mostly bottom up approach.
Yeah. Shreyash, given the current challenges in the banking sector, when can we expect a turnaround?
Oh, so banking sector, if you look at its movement, definitely as of now, there are, if you talk about growth, then there is a credit growth, which is from corporate credit and retail credit. Now, the corporate credit growth has been not great for long period of time now, more than 10, 12, 13 years, or at least almost 8 to 10 years, if not 12, 13. Since the corporate credit growth is not high, it's a retail credit growth driven bank and NBFC, which has been the favorite of the market for most period of time since last 10 years. Barring few again because of the power theme, some of those who are in that theme did well in last 2, 3 years. But mostly it has been about retail credit growth because that's the only space where the growth has been. Now, so this time around, what is observed is banks, the deposit growth and the credit deposit ratio, as well as all these things being interlinked and liquidity in the market. So these are, and obviously its impact on NIMs and then impact on ROA and ROE. So all these things are interlinked, and its adverse impact is seen on the banking sector per se, and banking sector valuations per se. Again, it's not that everything got derated. It's probably those 3, 4 big banks got derated in financial services. Actually, if you see, PSUs got derated during this time. The lenders to the power sector got related during this time. It's not that everything is not going well. It is just that the stocks which has very high weight in the large cap oriented funds, oriented benchmarks, they definitely have underperformed for the reasons as I highlighted, that it has been mostly about retail credit growth driven, and it has been about high ROE. So both these got questioned when the NIM started compressing. Actually, they expanded, and the expectation is that they will compress. The retail credit growth has been great, but recently in last 1 year or so, the credit cost also has gone up in that. So that has been one of the headwind. And thirdly, as I highlighted about deposit. So as and when these three issue gets addressed, in my opinion, this sector, one should evaluate more.
Yes, being a bank-sponsored AMC, does it have any informational edge over the other players?
See, banking as a sector per se, so there are certain sectors where there are high frequency indicators which are available very frequently. And there are sectors like B2B, so like auto ancillary or IT, where the high frequency indicators are not available. So you have to rely only on the quarterly results. If you take auto, then auto you get high frequency indicator every month end. Now, if you take bank, then there are multiple high frequency indicators, right? So you get credit growth fortnightly, then you get deposit, you get liquidity numbers, you have everything in the market. So that's where probably this is the sector which is actually I would call out, and the interest rate cycle is in front of you. The interest rate call is in front of you for everyone. So this is a sector which is actually as open as it can be.
Okay, now moving on to the new age companies, they are getting mixed reviews. So do you see the long-term potential here, or do you think they're more of a gamble?
New age sector, whichever and whenever they started, if you take across industries. So in retail, in quick commerce, in DTC, that is direct to consumer brands, or you can take it in the software or tech. But mostly in India, it has been the technology applied to for consumers and making that platform scalable. So I would actually call it as a platform sector. Instead of calling out new age, because by way of technology, it may not be really high tech. Most of the actually some of these platforms are more to do with their execution on ground than being exactly high tech per se. So I would call them as a platform businesses, wherein actually in case of new tech, if you want to add then EVs, then probably that is a technology as well to some extent. Definitely. So if we then, so these are the two parts of it, new age businesses. Now coming to especially the platforms, the observation here is whether technology, which is also one of the element of that platform, about apart from on ground execution, whether there is a first mover advantage, and whether whenever some new take or new age, whenever they are coming up, in most of the cases, these business models has been loss making, and they have been someone is funding for that loss, either some promoter or private equity, with the promise of becoming profitable. And most of the time, that promise of getting profitable is based on the basic assumption that it will be duopoly or near monopoly in some point in time. And that end game is very important to understand. So if that end game is far away and that end game is not visible and not possible in some cases, in situation, one need to be careful. And because it is inherently everyone is burning money out there. So when we use the word new age, and as I said, there are multiple ways to look at it. Some people only look at the loss making part of it. Some people only look at the technology aspect of it. Some people look at the platform aspect of it. And if you then try to look at from these multiple angles to these new age businesses, where inherently I would call out that yes, they are trying to disrupt the existing businesses by way of new approach. It may be because of different way of execution. It may be because of different way of product delivery. This end game is very much important, where whether there is going to be that near monopoly or duopoly or only few player, wherein that part to profitability is visible. If that is not visible, then definitely such businesses don't tend to create wealth. And we have seen that in multiple failures also in the market itself. That such platforms, if they how repeatedly people go to that platform, that actually becomes a most important aspect of it. And we have seen actually from the same company, one company actually launched 3 4 5 platforms, and the platforms where people don't go repeatedly, actually they didn't turn out to be as good as others. So there are multiple metric which we use in assessing this company, and then invest into it. When it comes to EV and more technology driven, so probably I would call out as a EV also as more technology driven, because here we have seen worldwide that the new players emerged totally out of nowhere. Especially in China, there were new players emerged. In US, a new player emerged from which don't have a auto background, and that's where again it is partly technology driven. And there as well, one need to look at all these aspects the way I told you.
All right. Well, with that, it's time for us to wrap up this chat. Thank you for taking the time for this conversation.
Thank you very much.